Picture this. Prices are falling, the news is shouting, and that little app on your phone has gone bright red. In moments like that, almost everyone feels the same urge to do something, anything. The reaction you actually pick in those few weeks usually decides whether you lose money, sit on your hands, or quietly come out the other side richer. Some reactions come from emotion, some come from a plan, and some get forced on you by debts and bills that don't care how the market feels. Here are the 10 main ones in the order a beginner should learn them. Paper loss versus realized loss. You open your brokerage app in the middle of a crash and there's a big red number staring back at you. That number is a paper loss. Some people call it an unrealized loss. The market is basically saying your shares are worth less today than yesterday, but you still own exactly the same number of them. Nothing has actually walked out of your account. A realized loss is a different animal. That only happens the second you tap sell at a price below what you originally paid. Until that moment, the loss lives on a screen, not in your wallet. Honestly, this one idea is the most important thing in this entire video, because almost every harmful move people make in a crisis comes from treating a paper loss as if the money were already gone. Panic selling. Panic selling is when you sell mainly because prices are dropping and fear has quietly grabbed the steering wheel. The trigger isn't a new plan. It isn't a change in your life. It isn't a fresh look at the company you own. It's just the feeling that prices will keep falling and you have to get out right now. The mechanism is simple and pretty brutal. You take a temporary paper loss and you convert it into a permanent realized loss, usually somewhere near the worst possible price. Learning to spot that little voice inside saying, "Sell because I'm scared," rather than "sell because something in my plan has actually changed," is probably the single most useful skill a beginner can build. Freezing or doing nothing without a plan. From the outside, freezing can look like calm patience. It really isn't. A frozen investor stops opening the app, stops checking the portfolio, and quietly stops the monthly contributions because seeing those red numbers just hurts too much. The mechanism here is avoidance. The portfolio isn't being sold, sure, but it isn't being managed either. And the regular buying that was supposed to keep going right through the downturn, that just quietly stops happening. So if you deleted your broker app because you were afraid to look, sorry, but that's not staying invested. That's freezing. And it really matters to keep those two apart because everything that comes next depends on it. Cash buffer changes the decision. Before you can even pick a reaction, real life still needs to be paid for. A cash buffer, most people call it an emergency fund, is the money sitting aside for rent or the mortgage, for food, for the kind of bill you simply cannot put off. If that buffer isn't there, a crisis quietly turns you into a forced seller of investments at the worst possible moment. Not because you panicked, just because the landlord still wants paying this month. And here's the sneaky part. The same chart drop that's totally harmless for someone with a few months of expenses in cash can be financially fatal for someone who pushed every spare dollar into the market. Your real options for how to react only begin once this layer's in place. Staying invested. Staying invested means holding on to the portfolio you built for the long term, even while the headlines are screaming. It's an active decision, not laziness, and again, nothing like freezing. The mechanism is participation. By holding a diversified portfolio, usually a broad index fund or ETF, you stay on the boat that will eventually carry you through the recovery whenever it actually shows up. But this reaction only works under two clear conditions. Your portfolio has to be diversified enough that it can actually survive the crisis, not one fragile stock. And your cash buffer has to be solid enough that you won't be forced to sell on the way down. With both of those in place, doing nothing on purpose turns out to be one of the strongest moves you've got. Market timing. Market timing is the attempt to sell before prices fall further, and then buy back before they rise again. It sounds clever, it feels active, which is exactly why it's the most tempting trap in any crisis. What makes it so dangerous is the mechanism. You don't have to be right once. you have to be right twice. You have to nail the exit somewhere near the top, and then nail the re-entry somewhere near the bottom, usually while everyone around you is still terrified. Most of the strongest recovery days in market history happen within a few weeks of the worst days. Miss just a handful of those, and the whole benefit of having sold in the first place quietly evaporates. Buying the dip. Buying the dip is a one-off, on-the-fly purchase made because the price has dropped and you're hoping it bounces back. It's not the same thing as a planned monthly contribution, and it's not the same thing as rebalancing. The mechanism is opportunism, usually with whatever spare cash you have lying around and a quiet hope that the bottom is somewhere nearby. The risk is that nothing tells you when to buy or how much. You can blow all your free cash on the first 15% drop, then watch prices fall another 20, and now you've got nothing left to deploy. There's a phrase for this: catching a falling knife. The asset keeps falling and the buyer has no plan to stop. Dollar cost averaging. Dollar cost averaging, usually shortened to DCA, means investing the same amount of money on a fixed schedule no matter what the market is doing. The classic example is someone with a paycheck buying into a broad index fund every single month, in calm markets and in crashes alike. The mechanism here is mathematical, not emotional. When prices are low, your fixed contribution buys more shares. When prices are high, it buys fewer. Across a long crisis, your average purchase price quietly drifts lower without you ever having to guess where the bottom is. DCA also takes the psychological weight off your shoulders. The decision was made once, in advance, instead of being made again every morning while the news is loud. Rebalancing. Rebalancing is a rule-based reaction, not a market forecast. That distinction matters more than it sounds. Most beginner portfolios start with a target mix, say 60% stocks and 40% bonds. When stocks crash, that mix can drift to something like 50-50 because the stock part has shrunk. Rebalancing means selling a little of the part that held up and buying more of the part that fell until your original 60-40 target is restored. The mechanism quietly forces you to sell high and buy low inside your own portfolio, mechanically, without needing any opinion about where the market is going next. And that's what makes rebalancing fundamentally different from buying the dip. The size of the trade is bounded by your written plan, not by your feelings about how cheap something looks today. Deleveraging, or forced selling. Every reaction we've covered so far has been a choice. This last one isn't. Deleveraging happens when an investor has bought assets with borrowed money, usually inside something called a margin account, and the value of those assets falls below the level the broker requires as collateral. At that point, the broker issues a margin call, which means the investor has to add cash or new collateral very, very quickly. Or the broker starts selling the positions automatically, at whatever price the market happens to be offering that morning. The mechanism is brutal. Even if you genuinely believed in your assets and were ready to wait years for the recovery, leverage takes that choice away from you and locks the loss in on your behalf. This is the main way investors don't just lose money in a crisis, they lose all of it. And it's probably the single strongest argument for a beginner to simply not borrow money to invest at all.